Have you ever wondered how money markets and foreign exchange impact your daily life? Well, let's dive in and explore these fascinating financial concepts. Money markets, often invisible but integral to our economy, are where short-term borrowing, lending, buying and selling happen with a maturity of 1 year or less. They provide liquidity necessary for a well-functioning economy. Think of them like a financial supermarket, where banks, businesses and governments go to manage their short-term funding needs. Now, let's zoom out to a global scale and talk about foreign exchange, or Forex for short. This is the marketplace where national currencies are traded. If you've ever traveled abroad and needed to convert your money into a foreign currency, you've participated in the Forex market. But it's not just for tourists. Businesses use Forex to pay for goods and services from other countries. The rates at which these currencies are exchanged, or Forex rates, are determined by various factors like interest rates, inflation, political stability, and economic performance. Now let's consider a simple but profound concept: the time value of money. It's the idea that a dollar in your hand today is worth more than the same dollar you would receive in the future. Why is that? Because money has the potential to earn more money over time. If you have a dollar today, you could invest it and, let's say, earn 10 cents in a year. Rather than waiting a year to receive that same dollar, you have the opportunity to make it grow. That's the earning capacity of money. These concepts of money markets, foreign exchange, and time value of money, they're not just abstract ideas. They're the gears that turn the global economic machine, affecting everything from the price of your morning coffee to your retirement savings. Remember, money today is worth more than the same amount in the future due to its potential earning capacity. So keep that in mind the next time you're making a financial decision. Now, let's delve into the world of bonds, equities, and the regulations that govern these markets. Starting with the basics, bonds and equities represent different types of investments. A bond is essentially a loan that you give to a company or government. In return, they agree to pay you back the principal amount plus interest at a specified future date. Equities, on the other hand, represent ownership in a company. When you buy a company's stock, you're buying a small piece of that company, including the right to a portion of the company's future profits. But what's the point of all this buying and selling? Well, bond and equity markets serve a vital role in the global economy. They provide a way for businesses to raise capital, and they give investors opportunities to grow their wealth. At the same time, these markets also help to distribute risk and promote economic stability. Now, let's switch gears and talk about financial regulation. Financial regulators are like the referees of the financial markets. They set the rules, monitor activity, and enforce compliance. Their main goal is to ensure that the markets operate fairly and efficiently. Regulation is important because it helps maintain market integrity. Without regulation, markets could be manipulated, leading to unfair outcomes. Regulations also protect investors from fraud and other unethical practices. For instance, insider trading, where individuals trade based on non-public information, is strictly prohibited. Regulation also promotes transparency, which is key to a functioning market. When companies are required to disclose accurate and timely information, investors can make informed decisions. Finally, regulation helps mitigate risk. By setting minimum standards and conducting regular inspections, regulators can help prevent excessive risk-taking that could destabilize the market. To sum it all up, bonds and equities are integral parts of our financial system, providing avenues for capital formation and wealth creation. And while these markets can be complex, financial regulators work tirelessly to maintain their fairness, efficiency, and stability. Regulation plays a crucial role in maintaining trust and stability in the financial markets. What do you know about equity indexes and how they guide investment decisions? Let's dive in. Equity indexes, also known as stock indexes, are essentially a snapshot of a segment of the stock market. They serve as a benchmark, providing a measure of the overall performance of the market or a specific sector within the market. Some of the most recognized equity indexes include the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. They are crucial in understanding market trends and making investment comparisons. Now let's talk about valuation. Valuation is the analytical process of determining the current worth of an asset or a company. There are several methods to valuation, but we'll touch on two of the most common ones: the price-to-earnings ratio, or PE ratio, and the discounted cash flow method, or DCF. The PE ratio is a simple tool that compares the price of a stock to its earnings per share. It can help investors gauge whether a stock is overvalued or undervalued. On the other hand, the DCF method is a bit more complex. It involves forecasting a company's free cash flow and then discounting it back to its present value. This method is based on the principle that $1 today is worth more than $1 tomorrow. Finally, let's explore investment vehicles, which are simply methods by which individuals or businesses can invest. Mutual funds and exchange-traded funds, or ETFs, are two popular investment vehicles. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. ETFs, on the other hand, are funds that track an index, sector, commodity, or other asset, but can be bought and sold like individual stocks on an exchange. So there you have it. Equity indexes provide a snapshot of the market, valuation methods help determine an asset's worth, and investment vehicles offer various ways to invest. Understanding these concepts can significantly enhance your investment decision-making process. Are you familiar with the terms derivatives, futures, swaps, and options? Even if you're not, don't worry. We're about to delve into the fascinating world of these financial instruments. Let's start with derivatives. Derivatives are financial contracts that derive their value from an underlying asset. This could be anything from stocks and bonds to commodities or currencies. Their primary role is in risk management. By allowing investors to speculate on future price movements, derivatives act as a form of insurance against market volatility. Next up, futures. A futures contract is an agreement to buy or sell a particular asset at a predetermined price at a specified time in the future. Picture yourself as a farmer. You plant your crops today, but you're unsure what the price of your produce will be at harvest time. To protect against potential price drops, you can enter into a futures contract, agreeing to sell your crops at a fixed price when they're ready. This way, you've hedged your risk. Now let's talk about swaps. A swap is a derivative in which two parties exchange financial instruments. Most commonly, these are cash flows. For instance, Company A might swap its fixed interest rate payments for Company B's floating rate payments. This can be advantageous if each party has access to a different type of interest rate. Lastly, we have options. An option gives the holder the right, but not the obligation, to buy or sell an asset at a specified price within a certain period. Think of it as a form of insurance. If you own a stock, you can buy a put option as a form of protection. If the stock price falls, you can exercise your option and sell the stock at the higher strike price. These financial instruments serve as tools for hedging risk and speculating on future price movements. They're like the Swiss Army knife of the financial world, offering a range of solutions for different market scenarios. So, whether you're a farmer, a corporation, or an investor, these instruments can offer valuable strategies for managing financial risk. Ever wondered how companies raise capital through equity and bond IPOs? Well, the world of finance provides a myriad of mechanisms, and one of them is through credit derivatives and initial public offerings, or IPOs. Let's dive into credit derivatives first. In essence, these are financial contracts that allow parties to manage their exposure to credit risk. Credit risk, as you might recall, is the risk that a borrower will default on their obligations. With credit derivatives, this risk is transferred from one party to another. Think of it like insurance for your financial investments. A common example of credit derivatives is a credit default swap, where the seller agrees to compensate the buyer in the event of a loan default. Now, moving on to the fascinating world of IPOs. An initial public offering is a process where a company offers its shares to the public for the first time. It's a significant milestone for any company because it provides them with the capital needed to grow and expand. Let's break it down a bit. Before an IPO, a company is considered private. Its shares are owned by a small group of individuals, typically the founders, early investors, and employees. However, when the company decides to go public, it sells a portion of its equity to public investors, essentially opening the doors to anyone who wants to buy a piece of the business. The process of conducting an IPO involves numerous steps. It starts with hiring an investment bank to underwrite the offering, followed by filing necessary documents with regulatory bodies. The company and its underwriters then set the offering price and date, after which the shares are sold to the public. The funds raised through an IPO can be used for various purposes, such as funding research and development, paying off debt, or expanding into new markets. IPOs represent a significant milestone for companies, providing them with capital for growth and expansion.